In this video, we are going to be covering the Milwaukee rental market for multifamily properties. As you can see on the map, I have it scrolled out. We've got the Milwaukee metro statistical area drawn out right here along Lake Michigan. And I just wanted you to see kind of where it was in case you didn't have an idea. It is in the southeastern part of Wisconsin. You can see we have Chicago, Illinois here. We have Fort Wayne, Indiana down here. Toledo, Ohio here, Detroit, Michigan here. So this kind of gives you an idea of where it may be. And as you can see here, this dark line going up this way is the U.S.-Canadian border. So let's bring this in a little bit. And let's take a look at the filters we are using. And as always, we are excluding all corporate, all military, all senior, and all vacation. And we are only including market and market affordable. If we go over to location, we can see that we are in market, metro markets, and the Milwaukee metro statistical area. So let's go take a look at our analytics and see what the supply snapshot shows us. So here's the supply snapshot for the Milwaukee, Wisconsin metro statistical area. You can see there are 3,577 properties totaling 112,834 units. There are still 4,952 units currently under construction and 1,631 absorbed in the last 12 months. The prior period in 2021, they absorbed 2,998. So not too much of a disparity there. We are pretty low on vacancy rate in this metro statistical area. It is by far the lowest we've seen yet, but it has ticked up from 3.3% to 4.2%. So let's see what the data shows us when we go and take a look at it. We can also see a year-over-year increase in rents. We'll take a look at it on a quarter-over-quarter basis. If we come down to our long-term occupancy average, we can see that this market likes to be balanced at 94.76%, and it's currently at 95.84. So probably, well, definitely above the long-term occupancy average, and probably going to be in oversupply side of the vertical line, the what I call the NOI line. So more than likely in phase 3 oversupply for this market, but we will take a look and see what the data shows us. And I'm only saying that because it does look like vacancy is increasing upward. We'll see what the rents are doing at the same time. So let's go look at the data for Class A, B, and C properties combined. Then we'll look at each one individually. So here is our data. As always, we are not going to look at asking rent. We will only be looking at effective rent. And we can see that first quarter of 2022, the rents were $1,239 a month. They went up to $1,263 in the second quarter, down to $1,251 in the third quarter, and then slightly ticked up in the fourth quarter. So a little bit of a stabilization here. The only other place we've seen this has been Miami and Fort Lauderdale. Although we did not see this tick up in all three asset classes in Fort Lauderdale, it was in one of the asset classes. It was either A or B's where we saw that little bit of a tick up. So interesting. Let's see what our deliveries and absorption shows us. So we can see there were some deliveries in 2022, 580 delivered in first quarter, 484 absorbed. I like that. Remember, I always say, if you can get 80% absorption or higher, you can stay in a stabilized market. 686 delivered in the second quarter, 661, almost 100% absorption there, right? So real good absorption first and second quarter. Now, third quarter, we've got some slowdown. And then a stoppage in the fourth quarter. So we are getting a little bit of slowdown in absorption. We are still getting units absorbing. We have another 822 in the third quarter and 352 in the fourth quarter, with 367 absorbed and then 0 absorbed. So It's interesting that the rents ticked up from third quarter to fourth quarter, considering we are slowing in absorption. So we'll have to see which asset class is causing that. But we definitely had a stabilized occupancy, which our absorption shows us it should have been. And then as the absorption slowed, the vacancy started ticking up, occupancy started ticking down. And that is exactly what this is indicating, albeit we are still really low in vacancy in this market. But remember, it's under 5% long-term, or right at 5% or just below 5% long-term occupancy average anyway. So we're getting close to that point, but we're still slightly above it. So let's see what the Class A data shows us. Here's our Class A data. We currently have 94 properties totaling 12,746 units in the Milwaukee MSA. We're looking at effective rents. The rent started at $18.36 in the first quarter, went up to $18.82, down to $18.27, and then a very, very slight tick up, almost stabilized increase, only $2 a month in the fourth quarter. So pretty much stabilized between the third and fourth quarter. Let's see what our deliveries and absorption tell us. So we delivered 208 in the first quarter, absorbed 81, little weak. Delivered 575, absorbed 319. Still a little weaker than I'd like to see it. It's about 2/3. I like to see it 80% or more. Delivered another 259, only absorbed 150, and then 87 caught up because we didn't have any deliveries in the fourth quarter. So that additional 87 units coming to the market after we had very slow absorption, or slow absorption. I wouldn't say very slow absorption. We had slow absorption first three quarters, and then because we had no deliveries in the fourth quarter, it caught up a little bit. So that could explain the $2 increase. But we are seeing that the occupancy trended downward until those 87 units absorbed, and that gave it just a slight tick up in the occupancy, which again would cause those rents to go up. So the A's are reacting the way they should in accordance with their deliveries and their absorption. So demand supply is doing what it should for the Class A space. Let's see what it's showing us for the B's. So here is the Class B market. You can see we have 703 total properties totaling 46,181 units. We are looking at effective rent, and we started 2022 in the first quarter with $13.27 a month, went up to $13.55, down to $13.45, and a slight tick up in fourth quarter. So all three so far, all combined, A's and B's, all show this little slight tick up in the fourth quarter. So this is very interesting. Let's see if deliveries and absorption tell that same story. So we have 372 units delivered in the first quarter, 338 absorbed, good absorption. 111 delivered in the second quarter, 375. So we should be having an increase in occupancy, and we are. That is exactly what it's supposed to say. And that would explain our up increase in rents. Then we have 563 delivered, only 302 absorbed, so a little bit of a slowdown. And then 352 delivered with 14 more going vacant. So this tells us that we really should not have had that slight tick up in the rents for the Class Bs. But there's probably an indication where those rents ticked up a little bit because the absorption hadn't quite caught up with the additional absorption from the previous three quarters. So I'm not going to complain about it too much like I do with Class C market, and we'll see if the Class C market has held true with all the rest of the markets we've looked at where the absorption was negative in all four quarters, yet we had rent growth in all four quarters. I don't think Milwaukee's going to tell us that story, but let's see if it does. So let's take a look. Okay, so here's our Class C data. We have 2,613 properties, totaling 53,246 units. Again, effective rent. We started the year in 2022, first quarter at 928, went up to 940, stabilized at 940, didn't move. So that's one of the first times we've seen this. And then ticked up slightly in the fourth quarter, as we've seen with all three of the other reports that we've looked at for combined A's and B's. So all of them are showing this uptick in the fourth quarter. Let's see if absorption tells us that, because we shouldn't have any deliveries. As expected, there are no deliveries, and yeah, we see this over and over in every market. I really didn't expect this in this market, but we are seeing people leaving the Class B space now, or Class C space. Now, this could be because it's so small that they may be moving to better apartments, so they may be upgrading to the Bs. There was absorption in Bs except for the fourth quarter, so this would not explain the fourth quarter. You do not get people that move from Class C space to Class A space, so I would discount that. But we probably have in the second and third quarter negative absorption. We probably are looking at some of them going up to Class Bs, and some of them may actually be doubling up because the rents are starting to get a little higher than the renters want to pay in this market. I do not blame the ownership in this case for continuing to raise these rents, because this vacancy is still really small, 3.3%. If I owned in this market, I would continue to raise my rents until that vacancy got to that 5% level, where the long-term occupancy average is, which is where you should be at a stabilized market in this case. So this is one of the few markets where I do not blame the ownership for continuing to raise rents, because we are still really, really low vacancy, and this is pretty small absorption. But we can definitely see a slowdown in all three asset classes. We have had some stabilization in the rents. We are seeing some uptick in vacancy. So I would put this in an oversupply situation, so in phase 3 for the current real estate cycle. And I would put it probably only one spot over from equilibrium, or that vertical NOI line on the market cycle chart, just because it looks like we got a lot of room to grow here, and any change in this market at all positively could possibly put it right back up to equilibrium. And it looks like if it wasn't for the uptick in vacancy, albeit slight, I'd have it sitting right on that equilibrium line. So I think it's closer to equilibrium than it is to the long-term occupancy average in this case. So I would really put this market similar to Miami. So this has been probably, I'd say, the second best market we've looked at so far in all of the videos we've done. I believe this is video number 18 of all the ones we've done at this point. So that said, that is the Wisconsin Metro Statistical Area rental market update for multifamily properties. Stay tuned tomorrow for Baltimore, Maryland. I will see you guys tomorrow.